Michal Meidan, head of China Research Program at the Oxford Institute for Energy Studies. Michal, we had some fairly positive noises out of the IMF overnight, raising growth forecasts for China. Have we been underestimating China's economic performance this year, and with it being a bit bearish on where its pull on oil prices can be? Your thoughts on the IMF announcement?
Good morning, Sean. Look, I think we tend to see this slew of bearish sentiment in Q1, and Q1 data from China is always patchy. And then people tend to sort of coalesce in terms of their GDP forecasts starting in Q2, especially if Q1 wasn't dreadful. We've been hearing a lot of noises out of China about stabilizing the real estate sector. But, the IMF is fundamentally aligning with the Chinese government sort of around 5% GDP forecast for the year. It is becoming harder to read because the traditional drivers of growth, like the real estate sector, are no longer what is really driving both economic activity and sentiment in China. And so it's really, I think, a bit of a kind of matching game. The reality is that the recovery remains relatively weak and very, very complex. The government's looking to stabilize the real estate sector, but that's very difficult. There's a problem with employment, there's a problem with consumption. Now, what's called the new productive forces, right? This big industrial push to do electric vehicles, batteries, solar panels, that is all still maintaining growth and helping it, but it's probably not enough to keep a very sort of bullish outlook for the Chinese economy.
Despite the IMF's correction of expectation upwards of Chinese growth, up 0.4% for 2024 and 2025, so up from 4.6% up to 5%, but they still signaled that China could do more. The old school scorecard, could do better in the property issue, in addressing China's property sector issues, more comprehensive policy packages. And you mentioned it in your earlier comment that it remains. But my question to you is, this is not a new headline. This has been with us probably a year now, since Evergrande first had its big drama of whether we were on the doorstep of a US scale, property crisis like we saw in 2008-09. So the Chinese government's had a good year at trying to chip away at this problem. My question is, are they making any impact? Is it getting any better? Is it getting any worse? Where we are in the progression? Because it's a year now since this red light started flashing.
Well, and it's been much longer, right? Since the real estate sector has been a concern for the Chinese economy. It's a very fine balance, right? Between trying to stabilize the sector, but not reinflating a bubble. And I think we all overly focus on the real estate sector. I'm not convinced that that is what keeps the Chinese government up at night. Yes, it is one of the elements that they have to deal with because a lot of people's wealth and the economy is tied into the real estate sector. But if you look at their priorities, and of course, we'll see more about that in the July plenum, the big Communist Party gathering that's going to happen. They are equally and even more worried about local government debt, which is what is actually the fuel of the economy, of employment, of job creation, of the social security that they need to set up in order to put China on a more sort of sustainable footing longer term. They're equally concerned about the securitization of the economy with, a very negative external environment from a geopolitical perspective, not necessarily also from an economic perspective, but they see a lot of threats coming in. And so what we or the IMF would look at is say, this is where you should be heading because you want to reach certain economic outcomes, is not what the Chinese government is looking at. And so I think we need to stop focusing so sort of fixedly or solely on the real estate market. And again, I think the key word and the buzzword in China now is the new productive forces, and these are the new industries. And of course, industrial overcapacity is something that we see in the news frequently. Those are some of the drivers of industrial energy demand growth. And in terms of oil, right, it's transportation that is still a big driver of growth. Certainly jet, a little bit of gasoline, and the chemicals sector, which is leading. So the other element, and it alludes a bit to what Ilya was saying earlier, is that there is a disconnect between the macroeconomic fundamentals and where oil is going in China in terms of the demand outlook.
I wanted to get your thoughts on where China goes at the moment vis-a-vis these so-called tariff wars. I have to say, I come out of it with the sort of big headlines recently of the EVs into America being quadrupled on their customs duties, China EVs to America from 25% to 100%. Will China retaliate, etc.? Where is that at? How big of a face-off is this? And where does it start to suck in? You're either with us again or against us, i.e. in all of the other countries that are sort of caught in the middle. But just first of all, where is the US-China piece at the moment?
So symbolically, it's huge, right? Symbolically, it's a massive issuance of tariffs. I mean, in reality, it's quite small because all of the goods that are in that list are already under tariffs, and there are relatively few exports directly from China to the US. But it does set us up for the future. It sort of sends the signal that we don't want your goods and products going forward either. So symbolically, again, not great. I think the Chinese understand that this is just as much about electoral grandstanding as it is about wanting to protect the domestic market and sort of gear up for that race with China for new energy supply chains. I think the reality is that it is going to make the decarbonization and the US's energy transition that much harder. I mean, Chinese goods components are much lower cost and they are abundant. Chinese capacity now is probably enough to supply the world in sort of various goods 2 times over, again, depending on which part of the new energy supply chains you're looking at. But, you know, China, I think, will retaliate. I think what they try to do is find a symbolic way to retaliate that doesn't hurt the Chinese economy, that sends a signal. I think they'll probably look to target maybe agricultural products or something that hits an electorally important state, again, to send a message. But this, what is now tit for tat and slightly contained, will just continue to escalate and becomes bigger. I think what it does then is add costs, logistical constraints, which all feeds into sort of inflationary pressure and ends up slowing down the energy transition. Third countries, however, stand to benefit from some of this because there's this move by Chinese companies as well to relocate supply chains into FTA countries or other countries where their goods can go into the US. And of course, the big concern is that the EU follows suit and imposes all these tariffs and duties on Chinese goods. So actually, some third countries benefit from this because they get more investments, more infrastructure, more outflows, and sort of new parts of their economies emerging. I think net, if we look at it from an energy and oil perspective, it does increase demand, right? There's just a lot more activity that's happening, but it is shifting in terms of geography. It is, I think, creating more jittery and nervous markets because you never know when another shoe is going to drop, and that shoe will have sort of ripple effects that were unintended, but that are much more meaningful than, you know, what was a symbolic gesture. And I think that's really been the issue. And we've seen it, right, with Russia and Ukraine. The unintended consequences are the ones that can be the most impactful and harmful.
I wanted just to get your thoughts also on the other point made in the IMF statement overnight, which was, yes, a revised upward growth for China in 24 and 25, but notably as the out years start to decline, and by the end of the decade, 2029, they're forecasting closer to 3% growth. And while that might be a few years away, it's still close enough from the point of view, are you going to invest $20 billion in a new oil field when China demand may be peaking? Your thoughts on the intersection point of that outside years more significant decline in China growth and where it will feature for that marginal oil demand?
I mean, let's not forget that 3% growth on the kind of economy that we're seeing in China today is still massive. And you compare it to 8% from a much smaller economy, that is still very sizable growth. In terms of oil demand, it's really interesting that oil demand is likely to peak. Product demand is, and certainly gasoline, is likely to peak in the next couple of years. I mean, diesel is an interesting one because we've heard CNPC or PetroChina say that it's already peaked in 2016, and yet we're seeing pretty solid diesel demand growth on freight, on industrial activity, but we've got chemicals and jet that will sustain oil demand certainly into the next decade. So there's still, I would say, at least a decade of demand growth from China. The other thing, if you look at a variety of forecasts, be they sort of IEA or corporate forecasts out to 2040, 2050, even as China's oil demand growth slows and then gradually starts to peak and decline, China remains the biggest oil consumer and importer in the world for another decade. Now, again, that growth sort of demand levels could go from the 14, 15 million barrels a day today to, again, your forecasts go from 10 million barrels a day to 5 million barrels a day in sort of the late 2040s. But even so, it's still the biggest demand center. And so for producers, that is still going to be the main sort of the main demand source in the market that they will be vying for.